Welcome! In this video, we're going to answer a very common business question. Which factor helps determine a company's credit rating? The key factor we'll focus on is the interest coverage ratio. We'll take it slow, use a clear diagram, and work through a real example step by step. First, what is a credit rating? Think of a credit rating like a report card for a company. A high grade means the company is very likely to pay back the money it borrows, and a low grade means there is more risk. To visualize this, let's draw a simple report card with grades like triple A, double B, and C. The higher the grade, the safer the company looks to lenders. One of the key factors that influences these grades is called the interest coverage ratio. This ratio measures how easily a company can pay the interest on its debt using its earnings. The bigger the ratio, the safer the company looks. If the ratio is low, it means the company might struggle to pay the bank. Let's write the formula now. Let's explain the pieces of this formula. EBIT stands for earnings before interest and taxes. That's the money the company makes from its business before paying the bank or the government. The interest expense is simply the interest payment the company owes for borrowing money. So the ratio is asking, how many times can the company's earnings cover its interest bill? Now, let's build an intuitive picture. Imagine a safety gauge. A high ratio is like the needle pointing to the green safe zone. A low ratio is like the needle dropping into the red danger zone. We'll draw a simple gauge that compares high versus low coverage. Notice how the needle in the green area shows a safe company. If the ratio drops, the needle moves toward the red. That signals more risk and a lower credit rating. This is why rating agencies care so much about this ratio. Let's do a full example. Suppose a company called the Toy Box earns $20,000 in EBIT for the year. It owes $4,000 in interest expense. We'll compute the interest coverage ratio step by step. First, we plug in the values into the formula. Then we divide 20,000 by 4,000. That gives us a ratio of 5. This means earnings are 5 times larger than the interest bill. That is usually considered healthy, and it helps the company earn a better credit rating. A ratio of 5 means the company has a cushion. If sales slow down, it can still make the interest payments. That's why credit rating agencies reward a higher interest coverage ratio with a stronger rating. If the ratio were below 1.5, the company would be close to not covering its interest, and the rating would likely be lower. Let's recap slowly. A credit rating is like a report card. A key factor on that report card is the interest coverage ratio. The formula is EBIT divided by interest expense. A higher ratio means a safer company and a stronger credit rating. A lower ratio means more risk and a weaker credit rating. In our example, the Toy Box had a ratio of 5, which is healthy. That's the main idea.